Dear students, in this module we will cover the various concepts of gross national income and purchasing power parity. Let's discuss about gross national income. The gross national product, the GNP, is a broad measure of a total economic activity of a nation. The GNP, in short form, is the value of all only finished goods and services produced by nations in 1 year. Gross domestic product, GDP, is the total market value at current prices of all final goods and services produced within a year by various factors of production located within a country. It's a key concept in the gross national income. Net national product or net national income is another concept which is usually defined as net national product or net national income. At market prices is the net market money value for all the final goods and services produced in a country during a year. It is calculated by subtracting the amount of depreciation of the existing capital in a year from the market value of all final goods and services. Let us discuss about the definition and explanation of gross national product. The concept of GNP is very comprehensive. It enables to measure and analyze the total or aggregate economic production of a country in a given period or 1 year period. The gross national product of a country, GNP, is defined as the total money value of all final goods and services produced by the residents of a country in one particular year. The gross national product may be defined as the current value, market value of all final goods and services by the economy during an income period, regardless of where the output is produced. We should remember the following aspects about the GNP. The GNP is a flow concept. The GNP represents a flow. It is a quantity produced per unit of time. It is the value of final goods and services produced in a country during a given time period. The GNP measures final output. While calculating the GNP, the market value of only final goods and services produced in a year are added up. Final goods are those goods which are purchased for final use in the market. The GNP is output produced by the citizens of a country. The GNP is the final output of goods and services produced by the citizens and businesses of a country during a given time period, which is usually a year. For example, the economic activity carried out by the USA citizens and businesses outside the country is counted in the GNP. The income of the residents who are not USA citizens is subtracted from the GNP. Let's discuss about components of expenditure in GNP. For measuring the GNP at market price, the economists use expenditure approach as described below. There are 4 categories of expenditures which are added together to measure the GNP at market price: consumption, investment, government expenditure and net exports. Consumption expenditure, C, it includes all personal expenditure incurred by the citizens of a country on durable and non-durable goods in a period of 1 year. Investment, I, it is the total expenditure incurred by firms or households on capital goods. Government expenditures, G, it includes all types of expenditure incurred by federal, provincial, local councils on the purchases of goods and services such as national defense, law and order, street lighting, etc. Net exports, the difference between X and M. Next exports of goods and services are value of exports minus the value of imports. The formula of the GNP is GNP is equal to C plus I plus G plus X minus M, where C is the consumption, I is the investment, G is government expenditure and X minus M is the net exports. Net national product or national income at market prices is the net market money value of all the final goods and services. It is calculated by subtracting the amount of depreciation of the existing capital in a year from the market value of all final goods and services. For a continuous flow of money payments, it is necessary that a certain amount of money should be set aside from the gross national income for meeting the necessary expenditure of wear and tear of all capital equipment, so that there should not be any deterioration in the capital and it should remain intact. If we deduct depreciation allowance from gross national product, we get net national product at current market price. The formula for net national product or national income, NNP at market price, is equal to GNP at market price minus depreciation. Depreciation allowance and maintaining capital intact. It is known to everyone that when production is going on, the value of capital equipments does not remain the same. A decrease in value because of wear and tear through use, rusting, accidents, or through actions of elements gradually take place in the building and other equipments of business. A certain sum of money based on the value of capital equipment and its longevity is set aside every year from the gross annual income, so that when machinery is worn out, new capital equipment can be set up from the sum thus accumulated. This fund, which is set aside for covering the wear and tear, deterioration and obsolescence of the machinery, is named as depreciation allowance. We can make this concept more clearly by taking a simple example. Example of NNP. Suppose a person buys machinery for manufacturing cloth for $10,000. He expects that this machinery will last 10 years and after that period it will be partially or completely worn out. He sets aside $1,000 every year from the gross national income as a depreciation reserve of the capital equipment. After the expiry of 10 years, he accumulates $10,000 and with that money he replaces the old capital equipment which has lived its useful life and maintains capital intact. The sum of money, that is $1,000, which he annually deducts from the gross annual income, is known as depreciation allowance. It is often pointed out by economists that the calculation of depreciation allowance every year is a difficult task. For example, a person expects the longevity of the capital equipment, say for 10 years. There is a possibility that machinery may last longer or it may go out of use earlier. So, they say what needed is an approximate decision regarding the depreciation allowance. This decision should be based on high degree of judgment and guessing about the future. In economics, by the phrase maintaining capital intact is meant to make good the physical deterioration which has taken place in the capital equipment while creating income during a given period. This can only be made by setting aside a certain amount of money every year from the annual gross income, so that when the income creating equipment becomes obsolete, new capital equipment may be created out. If the depreciation allowance is not set aside every year, the flow of income would not remain intact. It will decline gradually and the whole country will become poor. NNP is equal to GNP minus depreciation. Let's discuss about gross domestic product, GDP. The GDP is the total market value at current prices of all final goods and services produced within a year by the factors of production located within a country. The labor and capital of a country working on its natural resources produce a certain aggregate of commodities, material and non-material every year. In addition to this, there may be foreign firms producing goods in the various sectors of the economy like mining, electricity, manufacturing, etc. If we add up the money value of all the final goods produced both by domestic and foreign owned factors annually in the country and valued at market prices, it will be called gross GDP. The GDP thus is the value of aggregate or total production of goods and services in a country in a year. This constitutes the gross national product of a country. If a detailed list of all such commodities produced annually or measure the total goods produced during a year by weight or by volume, it will not give anybody a clear and concise impression about the total national output. So, what generally is done, that the money value of all final goods and services produced during a year at current market prices is added up. This total current market value of all final goods and services produced is to be calculated and considered. There are certain problems in measuring GDP. Stress on final output. While calculating the gross domestic product GDP, the value of only those goods which are to be added which have reached their final stage of production and are available for consumption. The primary or intermediary goods are not counted in the GDP. For example, table made of wood is the final product. The wood used in making the table is a primary good. While calculating GDP, if we include the value of wood as a separate item and the value of table separate, it will be a case of double counting, and this leads to inflated rise in the GDP. The other method which we need to know is value added method. Another way to avoid pitfall of double or multiple counting is to calculate only the added value of a particular commodity at its every stage of production. The result in both the cases will be the same. Suppose the price of a book which you are reading is, say, $10. This includes the cost of paper, printing and binding charges, etc. While estimating the gross domestic product, there are two ways. Either to include the final price of the book at one time in gross domestic product, or you add up the added value at every stage in the process of the production of the book. But you are not to count the value of a thing more than once. From the following example, it can easily understand as to how the danger of double or multiple counting can be avoided. In the example, the left side indicates the stages of production. So, say there are stage 1, stage 2, 3, 4, 5 and stage 6. There are different forms of products, like in stage 1 jungle wood, in stage 2 the price of wood after transporting to the city, stage 3 paper manufacturing, stage 4 printing of book, stage 5 binding and title and etc. Stage 6, sales price. At every stage, there will be a price which has to be taken into account. Say for example, in all these 6 stages, the price at each stage starting from stage 1, 0.25, stage 2, 0.38, stage 3, 2.00, stage 4, 5.00, stage 5, 6.00 and stage 6, $10. So, the total will become $23.63 which are at every stage by taking aggregate. The value added at each processes, it will become at stage 1 0.25, whereas at stage 2 the difference between stage 2 minus stage 1 of price, if we deduct, it will come to 0.13. And similarly, stage 3, which is a price at each stage, if we take it 2.00 and if we subtract 0.25 of stage 1 plus 0.38 of stage 2, and from this 2.00, the value added at that particular for the process will be coming to 1.62. Similarly, if we take into consideration of the stage 4, then the difference will come to 5 minus 2.00, which is equal to 3 as a value added at that each process. The stage 5, which has the price at each stage of 6 minus stage 4 price of 5 will bring the value added as 1.00, and the last stage, that is sale price, will be as the difference between the price at that stage of 10 minus the earlier stage 5 of 6, which is the difference of 10 minus 6, which is equal to 4.00. So, by taking all the stages and adding the value that are added for each process will come down to $10.00. From the above example, it is clear that if we add up the value of the product at every stage of production, the total value of the book comes to US dollars 23.63, while in fact it is priced at US dollars 10 only. So, it can be concluded that while adding the value of the book to the gross national product, we should either include the final price of the book, which is US dollars 10, or we should add up the added value at each stage in the process of production. But we are not to count the value of a particular commodity more than once. If we do so, the gross product will be overestimated. The computation of GDP by this method is, of course, not much popular. Let us discuss about non-productive transactions which are excluded from the GDP. In order to measure the economic well-being of a society in a year, the non-productive transactions are to be excluded from the gross domestic product. There are two major types of non-productive transactions, namely 1. Purely financial transactions, and 2. Second-hand sales. Under purely financial transactions, 1. All public transfer payments which do not add to the current flow of goods, such as social security payments, relief payments, and 2. All private financial transactions such as receipt of money by a student from his father which make no contribution in current production are all excluded from the GDP. Similarly, the second-hand sales are excluded from the GDP as they do not contribute to current production in a year. There are certain other transactions also which have to be noted. There are a few other transactions which are not included in the GDP. For example, 1. Persons working in their own houses without any payment through the market, and 2. Housewives take care of house and children. Since these two types of individuals are not paid, therefore, the value added by them is not included in the GDP. exclusion of output production abroad. The GDP is the value of output produced by various factors of production located within a country. It excludes the output produced abroad by domestically owned factors of production. There are different distinctions between GDP and GNP. It seems necessary to make a distinction between gross domestic product and gross national product. Gross domestic product is the total market value of all final goods and services produced by factors of production within a nation's border during a period of 1 year. In other words, the GDP is a flow of production produced within the country by domestically located resources in a year. The gross national product GNP, on the other hand, is the measure of all final goods and services produced by the citizens within their own country as well as outside the country during a period of 1 year. In other words, the GNP expresses the money value of flow of goods and services produced within the country and the net income received from abroad during a period of 1 year. Thus, when we move from the GDP to GNP, we add factor income receipts from foreigners and subtract factor income payments to foreigners. Let's discuss about purchasing power parity, PPP. The concept of purchasing power parity has two applications. It was originally developed as a theory of exchange rate determination, and it is also primarily used to compare living standards of people across countries. Exchange rate. From the perspective of exchange rate determination, PPP is useful as a reminder that monetary policy has no long-run impact on the real exchange rate. Thus, countries with different inflation rates should expect their bilateral exchange rate to adjust to offset these differentials in the long run. The exchange rate, however, can deviate persistently from its PPP value in response to real shocks. To compare living standards across countries, PPP exchange rates are constructed by comparing the national prices for a large basket of goods and services. These rates are used to translate different currencies into a common currency to measure the purchasing power of per capita income in different countries. A PPP exchange rate constructed in this manner is not, however, an accurate measure of the equilibrium value of the market determined exchange rate. Macroeconomic analysis depends on several different measures to compare economic productivity of a country and standards of living between countries over time. One of the popular measures is the purchasing power parity, PPP. PPP is an economic theory that compares different countries' currencies through a market basket of goods approach. According to this concept, two currencies are in equilibrium or at par when a market basket of goods, taking into account the exchange rate, is priced the same in both countries. Formula is S is equal to P1 by P2, where S represents the exchange rate of currency 1 to currency 2, P1 represents the cost of goods X in currency 1, P2 represents the cost of good X in currency 2. Basket of goods refers to a relatively fixed set of consumer products and services valued on an annual basis and used to track inflation in a specific market of a country. The goods in the basket are often adjusted periodically to account for changes in consumer habits. To make a comparison of prices across countries that hold any type of meaning, a wide range of goods and services must be considered. The amount of data that must be collected and the complexity of drawing comparisons make this process difficult. To facilitate this, the International Comparisons Program ICP, which was established in 1968 by the University of Pennsylvania and the United Nations, the purchasing power parities generated by the ICP are based on a worldwide price survey that compares the price of hundreds of various goods. This data in turn helps international macroeconomies come up with estimates of global productivity and growth. The other component is the weights. There is a large gap between markets and PPP based rates in emerging market and developing countries, for most of which the ratio of market and PPP US dollar exchange rate is normally between 2 and 4. But for advanced economies, the market and PPP rates tend to be much closer. As a result, developing countries get a much higher weight in aggregations that use PPP exchange rates than they do using market exchange rates. The PPP, the alternatives to market exchange rates, using PPPs is the alternative to using our market exchange rates. The actual purchasing power of any currency is the quantity of that currency needed to buy a specified unit of a good or a basket of common goods and services. PPP is determined in each country based on its relative cost of living and inflation rates. Purchasing power plus parity ultimately means equalizing the purchasing power of two different currencies by accounting for differences in inflation rates and cost of living. The Big Mac Index, as an example of PPP, as a light-hearted and annual test of PPP, The Economist has tracked the price of McDonald's Corporation, a Big Mac burger in many countries since 1986, and it indicates the Big Mac Index has its flaws. First, the Big Mac's price is decided by McDonald's Corporation and can significantly affect the Big Mac pricing and therefore the index. Also, the Big Mac differs across the world in size, ingredients and availability. This being the case, the index is meant to be as an example of PPP that is used by many schools and universities to teach students about PPP. The difference between GDP with PPP, one way of thinking what GDP with PPP is to imagine the total collective purchasing power, for instance of Japan, if it is used to make the same purchases in US markets. This only works after all NX are exchanged for dollars, otherwise the comparison does not make sense. Which nations have the greatest purchasing power? Gross domestic product is the total dollar value of all goods and services produced by a country in a given year. It is one of the primary indicators used to evaluate a country's economy and can be calculated in market exchange terms. A country's GDP at PPP takes into consideration the relative cost of local goods and services produced in a country valued at prices of the United States. The 5 nations with the highest GDP in market exchange terms are the US, China, India, Japan and Germany. According to PPP, in countries where non-traded service costs are relatively high, goods will be relatively expensive, causing such countries' currencies to be overvalued relative to currencies in countries with low costs of non-traded services. Thus, we have seen that we need to understand that the concept of various economic aspects which are related to gross national product, gross domestic product and the PPP, which is very important for us to understand, and how these differentiated with respect to various developed and developing countries is an important aspect. As a part of population and development course, it focuses about how the economic development can be considered, and for international comparisons how these concepts have to be used, and it's with measurements are an important aspect which have been covered in this module.